Thanks everyone who's here right now for joining on time. Really, really appreciate that. As always, we will give other attendees a couple minutes, more like 90 seconds to hop on, and we'll get started right around 12:02. All right, it's 12:02, so we'll go ahead and get started. Thanks again, everyone who's here right now, and others will trickle in, but appreciate all of you who are here on time. Today's webinar is Reinvesting Your Real Estate Returns, Creative Strategies for the Modern Investor with Luis Guerrero. My name is Matt Moore. I do business development here at Camoplan. And before we get started, we got to do the obligatory disclosure, which is to say that this webinar is for educational purposes only. Camoplan doesn't provide any investment advice. We always encourage you to go reach out the counsel and advice from the respective professionals, whether they be CPAs, tax attorneys, advisors, etc. So before making any investment decision, we encourage you to do your own due diligence with the right professionals. If you have any questions that don't get answered during this presentation about the presentation, or you have questions about self-direction, you can always reach out to Camoplan at the contact information that you see on the screen in front of you. So without further ado, I'm going to turn things over to you, Luis. So let me stop sharing my screen and give it to you. And while you're doing that, one housekeeping issue is going to be about Q&A, which I highly, highly encourage. See, we have Jim on the webinar today, so I'm going to count on Jim to have lots of Q&A, but the Q&A portal will be open, the chat will be turned off. So please don't be shy, ask your questions as we go along on this presentation. It's always, I think, a lot more exciting when it turns into a dialogue as opposed to just being, one way, so to speak. So please ask your questions during the webinar using the Q&A portal, and I'll pose those to Louise as we go along.
All good.
Yep.
Okay. Yeah, thank you, Matt, for the introduction there. Yeah, nice to meet everybody virtually here. And this is my presentation. My company is called Finally Found PA. As Matt was saying, reinventing your real estate returns for creative investment strategies for the modern investor. I am the founder and CEO of my company. My partner, who's also the founder, co-founder, and COO of my company, is actually on the road right now, so he could not attend today. But you have me, so I will go over the presentation. Let's see here. All right. There we go. Okay, so pretty much what I'm going to go over is my company, how everybody here can potentially work with us in the future, investment strategies, securitization, quick returns, and how you could find our business online. So, Finally Found was the name of my company here. We kind of came across the name, kind of collaborated and debated a little bit, and we were like, you know what, let's just call it, Finally Found. It's, we have a slogan that says, your next opportunity is finally found, or, sometimes we'll switch it up and say, stop looking for your next opportunity because it's finally found. So, something a little catchy that, we thought about. So we founded the company. It's going to be on 2 years now, Actually, it's in November already, so yeah, this will be our 2-year anniversary. It's a company that me and my partner started. He's actually my brother. Just two entrepreneurs. We wanted to get into real estate. I know Ramon's not here, but I'll kind of touch on him in a little bit. But pretty much what we do is, we're an investment-based company, and our mission is to, uncover opportunities that others may, overlook in the industry. We create value where there's not much value to be seen. We specialize in identifying off-market and distressed properties, transforming challenges into profits. And, we pretty much do that with a mix of hustle, heart, and data-driven strategies. And, we are fair to the property owner, and, we come up with a win-win solution a lot of the time. So it's not like we just have one type of offer we, present to a seller in their situation. We may, get a little creative, and I'll touch on that in the presentation a little more. But pretty much, yeah, we do that while building a strong portfolio that drives long-term growth. So, it's kind of a mix of we mainly predominantly focus on the wholesale model, where we'll find properties and assign them off market to a cash buyer or an investor, or we'll take them down as a rental or a flip for ourselves, or for rather for our company. So a little bit about my background. I started working in corporate, like most people. I was working 8 a.m. to 6 p.m. I had an hour drive there and back. Oftentimes there was traffic, so I would say probably like an hour and a half. Um, Basically, long story short, I got suspended wrongfully, and it kind of left a really sour taste in my mouth. I just didn't appreciate, the way it was done. Like I said, it was wrongfully, so it wasn't really anything that was in my control. I was just with the company maybe for a month or two. Sent an email out to a customer by mistake that had some formatting that the customer didn't appreciate. So, long story short, they suspended me back in 2019. And I remember the day like it was yesterday. It was Friday the 13th, 2019. I was driving home and I felt like there was like a shadow over my head that was like right behind me as I was driving. And just something was telling me, just don't turn back. Don't, give somebody the control to do that to you again. And I left and I never went back. And I started my real estate journey. Did Was with an investment company for a while, who did something similar to what I do: buy, sell, rehab, and property management. I did over like 65 transactions since COVID with them. Learned a lot about real estate, mostly in New Jersey. And then in 2023, I co-founded my company, Finally Found. So a little bit about my partner, because he's not here. He started his journey by purchasing a triplex in the Poconos. He has a family. He has one child, and he is in the military. He serves in the Air Force currently. And while he's not doing that, he has the time to work on our company. And he's more of the back of the house, maintenance, making sure everybody gets paid, and making sure the systems and processes are running. My job is more like upfront. I speak with the sellers. I go on appointments. I go networking a lot. I go to maybe 2 to 3 networking events a week. So I'm constantly going out there, meeting new people, shaking hands, kissing babies, the good stuff, right? So a little bit about the target areas of where we like to market. So mainly we look in these 3 states: Pennsylvania, Delaware, and New Jersey. So starting in Pennsylvania, we focus on the eastern border, not Philadelphia, simply because there's a lot of politics that go on that restrict kind of the business that we're trying to build. So I just thought, when I was first starting this, that I don't really want to get into the beast of Philly or New York. So I kind of stayed away from those major metro areas. So Pennsylvania, where we focus on, is Lehigh County, Northampton County, Bucks County, Berks County, and Monroe County. So it's pretty much all the counties that are on the eastern border above Philadelphia. So everything on the eastern border that's not Philadelphia and Pennsylvania. New Jersey, we focus on Essex County, Passaic County, Sussex County, Warren County, and Hunterdon County. And Delaware, it was one of the new markets that we just recently started doing marketing. We focus on northern Delaware, Newcastle, and Kent counties. So that's where we look for properties there. And Matt, if there's any questions, I don't think I could see them, but if whenever you want to stop me, if you see anything that comes in, okay?
Absolutely.
All right. And yeah, just keep me posted on how I'm doing with time also.
Yeah, will do. You're great on time. No questions yet, but yeah, just keep
Okay.
going. I'm sure they'll come in.
So how we structured, our business is with investors, they could work with us in three ways, and we define them as the following. It's either the passive strategy, active strategy, or what we call passive aggressive strategy. It's kind of like a play on words. You'll kind of see in a minute, but it's pretty unique strategy. So passive, it'll be, secure, simple, and steady. Passive strategy will be structured either in the following ways. So just disclosure, every deal is different, right? Every deal is like a snowflake. No one deal is gonna have the same exact number, same exact structure, same timeline. So dependent on how I got the deal and what the seller is willing to do, and the terms of that deal will depend on how I structure it. So just a few ways to mention some, and it's not just limited to these ways, but some of the ways why I would structure a passive strategy relationship with an investor would either be in a form of a limited partnership, where they're basically just a silent partner. Me and my partner do the bulk of the work. We handle all the grunt work, and we have a limited partnership. We either do that, either a joint venture, or we can do it in the form of a first or second position lien against the property that we're purchasing. So pretty much the passive strategy is hands-free investing. Basically, you gain returns on rental or renovation projects that we're working on. You earn, above average returns, secured returns. As I said, while we do all the work, and you just sit back and collect your returns based on that particular deal. It's consistent cash flow, so you could either go with monthly payouts, quarterly, or annual distributions. I know we're dealing with retirement accounts, so I know the money will have to go back into your particular IRA account. So whatever money goes to any of these deals will have to go back into that account. So as I'm sure a lot of you know, and the deal will be backed by the real estate. So investments are secured by high valued assets. Ideal it would be for this strategy retirees or investors that are just seeking consistent, reliable, and effortless returns. So then the second strategy would be active strategy. Now, I'm not too sure if with the retirement account regulations, how it works exactly. So, maybe you have to have an like a third person who, has to handle the construction and the deal for you. But another way we can structure it is just an active strategy, where essentially the structure would be, again, it depends on the deal. It would either be in the form of a wholesale, where I'll just assign you the deal for a fee, to maybe your third party or whoever manages your property. Or we could do what is called an LLC buyout, where I'll set up an LLC just specifically for that property. That LLC will not have anything prior to it. I'll give you all the formation docs, and simply what we can do is I'm on paper just selling you the rights to that LLC. and then that LLC will have the asset under contract. So I do LLC buyout mainly for my Pennsylvania deals because there's some regulations right now that are restricting wholesaling in that state. So I may have to get a little creative on how I structure some of the deals in Pennsylvania in particular. And then the third would be what we call, we kind of coined the phrase the found method. And I have a whole slide on the found method and how that works. It's pretty great. And we came up with a really creative solution that is a true win-win-win across the board. Win for the seller, win for us, and win for you as an investor. And this active strategy is more hands-on wealth building. You could acquire the property directly and you'll maintain full control of the asset. I'm basically getting the property off market and assigning you the rights to that property, or as I said, one of those other structures, and you have full control of the property after that. And you take title and deed. Matt?
Louise, we did have one question come in,
Yeah.
and it's from Stanley. Would you have to be licensed as a dealer in order to participate passively?
If the investor has to be licensed?
I believe that's the question. Yeah.
Okay. No, no. So if you're just participating in the deal, it's going to be in the form of either like a limited partnership or in a structure where you have a lien against the property itself. So in either cases, you won't have to, be licensed. Obviously, as the disclaimer said, check, with your lawyer and your CPA, obviously. But from my knowledge, what I know, I do not believe you need to be licensed for any of those strategies. It's simply for the passive strategy, I'm purchasing the property and I use the funds invested to put it either into the property or into, fixing up the property or however I need to purchase the property. And then once those funds are deployed, you'll be secured by one of those methods, but pretty much all you are is, have either interest in the deal or you have a lien on the property. So you're basically in a position as a bank would, right? So if a bank is lending you money, they either have a lien against the property or some type of, collateral on the transaction.
And there's
So
I think it's a
yeah,
follow-up question. Is finally found listed as a dealer?
a dealer, I'm not too sure what you mean by dealer. If you mean like agent, no. So my company is an investment company. So we do everything off market, direct to seller. So I was gonna maybe touch on this later, but I'll kind of speak on it now. How we find all of our properties is direct to seller. So it's me, literally me right now, calling the seller, going on the appointment. And then once we communicate with the seller, whose house is not on the market, it's off market, we talk about the numbers. Let's say they want to sell it for 200,000. I write up a contract for 200,000. I tell them, hey, you're selling the property to me for 200,000. Here's the contract. I give them the contract and I buy the property. So it's the same process as if you were buying something on market through an agent. But the way I approach it is, just off market. So I go straight to the seller and I offer them exactly what I'm looking to offer them. So pretty much no agents involved, and everything is done direct party to direct party. I'm the direct buyer, they're the direct seller. So that's how I structure it, if that
Great.
answers. Um, so yeah, to continue, yeah, and mostly the active strategy will be, fully hands-on as soon as the transaction's complete. Yeah, you will take ownership of the property, you'll take deed, and you'll take title to that property. Again, if you're doing it through your retirement account, you may have to have a third party take deed and title, and then your retirement account funds their, project and what they plan to do with the property. So how we source our deals, yeah, we source deals, you own them. We secure, like I was saying, the deals off market and you take ownership to them and title. Another way where we can structure the active strategy is through creative financing, where I'll get the seller to give us terms, seller financing terms, where you either, pay a chunk up front, and then the rest of the price you could pay directly to the seller over time. And pretty much how that works is the seller will either take a second position lien or what I call is it's UCC1 filing, which will be on the purchasing entity, and it's a lien. I'll get into that as well towards my next slide. But essentially, creative strategies could be anywhere from seller financing to subject to when you take over the existing mortgage that is on the property. We can do it as a found method, which I'll explain, or we could do a hybrid of any of those three. So the active strategy will be, mainly for investors who want control and equity and long-term wealth, that are willing to put into work and a little more active. So that is pretty much the active strategy.
And Louise, on the passive strategies on the top row, I know that you mentioned limited. You have LP structures as well as first and second position lien structures. So
Mhm.
do you have opportunities for both equity positions and just pure debt?
Right, correct. So it there will be, and as I said, it's really case by case depending on the deal. Some deals I can structure as equity, as in the form of like a limited partnership or a joint venture, or in the form of, like you said, debt, where it'll be either be first or second position lien. Again, I don't really, I towards the end of the deal, I have some case studies that I could show, but I can't really give a definitive answer because it entirely depends on the deal and how the deal is structured, for me to answer. But theoretically, yeah, I'm open to both as long as it's structured correctly, and that the investor is secure. Obviously, that's my main thing. You have an asset that's secured and backed either by the real estate or equity in the deal, and if things go south, you either are on the deed or you have first position or second position lien. And I'll kind of get into how we can securitize seconds. I know some people are a little hesitant with that, but I get a little creative with seconds as well.
Awesome.
Okay, so let me go on here. So the next strategy is passive aggressive strategy. Again, we kind of had a play on words here. So it's more for short-term goals with long-term vision. So with the passive aggressive, it's a little more different in terms of how you'll get back your returns. So this one is similar in the way of the passive strategy, where it'll be structured as like a limited partnership, joint venture, or a first or second position lien. However, the difference with this strategy and how we structure this one is that instead of you getting a constant cash flow return, whether it be monthly, quarterly, or yearly, this is mainly for to fund like bigger projects for premium returns. So how it would work is, let's say we have a large flip, or we're doing a value add, rental, which we plan to refinance, and we have a high margin, for opportunity. We'll pretty much, as I said, we'll structure it either as one of the four that you see above. And how it works is, instead of us giving you monthly, quarterly, or yearly payments, it's structured as the lump sum is given once the deal is sold or once the deal is on the back end refinanced out. So essentially, we'll increase your returns. We'll give you a higher, percentage of the deal, but you're going to have to wait, for the money to come back. And once the deal is complete, whatever net proceeds that come from the deal, your returns will be based on that. But because you chose to wait for your returns, those returns will be increased and they will have a higher return, again based on the deal that we have set up. So basically, we'll execute the renovation, the management, the contractors, and the permitting. similar as the passive strategy. But the twist is it that the exit is that you'll receive your principal and interest once either refinanced if we're keeping it as a rental, or once sold if that's our end game to sell the property. So pretty much the returns are delayed until the transaction's completed.
And I'm you might have already said this or you're going to say it. Are we talking purely residential here or do you do commercial too?
Yeah, that's actually a good question. I don't have that in there. So I do anywhere from residential, commercial, land, small apartment buildings, anything that I could speak to the seller directly, I'm open to. Prior to this business, I started a business finding 40 to 100 unit apartment buildings in like Virginia, Georgia, and North Carolina. So I always had ambition in terms of kind of getting out there, talking with people, and just seeing what they're willing to do. I've had under contract, commercial mixed units. I've had multi unit properties before, so I know how to underwrite and look at pretty much almost all opportunities across the board. But mainly, what we're probably going to be seeing most of is either residential or commercial. Um, Land depends, on the land. Some land is a little more difficult to move than others, and mostly we won't be developing land. Either if we're taking it down ourselves, mainly it's going to be residential. But if they're an investor is looking for more of the active strategy and they want to purchase the property themselves, we do get land and apartments and other asset classes as well. So good question. So so the passive aggressive, I would say, is more for the investors who want stronger returns without the involvement. So pretty much the same structure as the passive strategy. Again, just with the twist that you're gonna have to wait for the funds to come back into your account until the deal is completely finished. So I mentioned a few times the found method. So how we explain it is basically a no money invested strategy. And the key requirements will be that the seller of the property needs to seller finance more than 30% of the purchase price. The other key component is if either we're buying the property or whoever the end buyer is, they need to have a first position loan, or if they have all the money cash themselves, they could, purchase it that way as well. But for this to work, ideally, you would probably want to get another loan so you don't have to use your money, and you would also need transactional lender who is pretty much going to bring the funds to close for the first position lien, and you'll need an investor friendly title company. So, how the found method works is essentially, yeah, the seller is owner financing 30% of the property. For simple math, let's say you're purchasing a property for 100,000 and the seller is owner financing 30,000 of that. So what you do is we could either structure it for you because these deals could be a little complex in terms of the paperwork and what needs to be said to the lender, what needs to be said to the title company. There's very specific instructions that need to be executed for this to work. So using the example of a property for 100,000, the seller's got to finance 30%. The end buyer, whether it be you or me, will get a first position loan. Most of the time, as you know, most of those loans are either going to want anywhere between, let's say, 15 to 30, or let's say 15 to 25% down on that loan for the most part. So pretty much, let's say you have a property for 100,000. For simple math, let's say that first position loan is going to require, let's say, 20% down, right? So you're going to need 20,000 to secure that property. And that's essentially where the transactional lender comes into play. The transactional lender is somebody who's literally going to bring the funds for 24 to 48 hours. and their job is bring the funds for transactions like these in particular, where on the back end, there's either seller financing or an assignment in place that's going to come back and pay that transactional lender after the deal gets closed. So that's the second leg of the transaction. The first leg is to make sure that this is organized right. And when you get that first position lien, essentially what you're doing is over leveraging the property. So you're getting that loan, that first position loan, for the whole 100,000 of the purchase price. So once that lender brings that cash to close, and again, they're going to ask for the 20% down. Transactional lender, will bring that day of closing, and essentially, what is done is the proceeds that go to the seller, the 30% or whatever percent they agree to seller finance to you, is their proceeds. And basically, this is where the title company comes into play. The title company has instructions to hold 30% of the seller's proceeds in escrow until the second leg of the transaction is completed. So what the second leg of the transaction is after the closing takes place, transactional lender funds the cash at the closing. First position lender funds the deal. First position lender sends the money in. The whole 100,000. So let's take out closing costs. Obviously, there's closing costs, right? So let's take out closing costs out of the equation. But let's just say, okay, the whole 100,000 is there at closing. 70% goes, 70,000 goes to the seller. The other 30% remains at the title company. And then what happens is after that transaction is completed, the title company has instructions to release that 30,000 to whoever the end buyer is going to be, because the seller is owner financing that 30% back to me as a buyer or whoever the end buyer is going to be. So pretty much you can get that back in the form of cash. The reason why you have to do it after closing, because if the seller wants to have a second position lien on the property, technically you cannot record two mortgages on the same transaction. So depends on the lender, but typically how it's done is it happens after the closing, either in the form of a UCC1, which I'll touch on, or a second position lien that's just recorded after the closing. So pretty much once that first leg of the transaction is done, those proceeds go back to the end buyer, and there may be a surplus where the buyer may even get money back at closing. So with the found method, how we're structuring it is essentially, we'll make sure that you don't have to come into the deal with no money out of pocket, but whatever residual that is there at closing will essentially take that as our fee. And then whoever the end buyer is, they have a first position lien, a first position loan that is ready to go. Let's say it's a rental property and the property is bringing in rental income. The rental comes in from day one. And then you'll have a second position note, or it'll be a UCC1 on the LLC or the purchasing entity, that you would either have to pay off. Usually, how I structure my seller financing notes is that I make no payments due for the first 12 months. So within the first 12 months, you can either, add some value to the property, and refinance. And then once you refinance out, you could pay the seller off that way. Or if you want to do it as a flip, you can just increase the value of the property, flip the property, and pay off the seller that way. So it's a pretty unique, and again, it's pretty complex in the terms of structuring this at the title company. But essentially, if as long as you have these four components, this could be done with essentially any property or any title company or any lender who's willing to work with you on this.
And we did have a question from Henry, and Henry asked, for the found method, if the seller is willing to finance more than 50%, but requires first position to cover the greater risk, do you take a different approach? And if so, in what ways?
Right. So that's a great question. So how I usually typically do it is, it depends on what my exit is going to be, right? So with the found method, if I already have an end buyer who is, willing to purchase the property, and that end buyer has enough capital to bring that money to closing, they'll get that money back, right? So whatever money, I prefer to use the transactional lender. It's usually easier. But let's just say in theory, yeah, if they hold, let's call it 70%, right? So the seller owner finance is 70%. In the case of a property is 100,000, 30,000 is going to go to the seller at closing, 70% is going to go back to you as a buyer. And let's say they want to be first position, I'll tell them, hey, that's fine. Day of closing, same thing. Transactional lenders get a bing that 30% that's needed to go to the seller. And then once the transaction's completed, um, essentially, I see what you're saying. You're saying in the case that if they want to be first, um, usually I negotiate that out, right? Because the key component is that you need a first position loan to bring that funds to the table. Because how are they going to bring you those funds back if there's not a third party lender who's bringing those funds, right? So those funds, don't appear out of thin air. So there needs to be some type of loan in place in order to do that. If a seller wants to be in first, again, I'll touch on this more on my securitization slide. But essentially, what I do is I'll tell them, hey, you'll have a second position lien. But how I could structure it is with a UCC1, where they'll pretty much have a lien on the purchasing, the entity of of that's purchasing the property, and they could use that to feel secure in their position. Because if a seller's telling me they want to be first position, um, typically, the route I go is, okay, so I'm pretty much going to get into this deal with no money out of pocket. So I'll probably structure it in the way of, okay, if they want to be first, I'll tell them, okay, so you have to seller finance 100%. So then no money's going to be needed at closing. So I would probably do it in that way to answer your question, because I see what you're saying. If they do that, there's nobody else that's going to bring the money at closing. So it really wouldn't work for the found method. The found method is more for a seller who say they need the proper, they need to they sell the property, but they want to sell it for a certain amount, but they're not needing all of their funds up front. Usually, I typically do this from anywhere from 50 to 30%. But a key requirement is that, yeah, they have to understand that they're not going to be first position, or else that first position lender is not going to be able to bring the funds to the closing table. So that is a key component, and I can't really do this unless the seller agrees to that.
Great. Louise, just kind of
Mhm.
keeping in mind time here, about how many more slides do you have left?
Yeah. About like I would say four more.
Okay, great. Yeah,
And then I'll kind of,
let's get to it.
yeah.
Cool.
So securitization, as I was saying, usually is in the form of first or second position lien. And how I said was with my second position, right? So this is what I was saying. The rights that I give to the seller, I can do intercreditor rights with ALR, which stands for additional lender rights. So essentially, what intercreditor rights is the whoever is the senior lender in the transaction, they give the junior lender rights to step in to remedy any defaults. So let's say, for an example, if there's a case of a default or foreclosure that's taken place, whoever's in second position, because a lot of people don't like to take second position, they depending on the lender, right? The lender may be able to communicate with whoever's in second and say, hey, just so you know, Lewis or whoever's buying the property is falling behind. Do you want to step in and cure that remedy so the loan is brought current? Because as you know, the first position has the right to wipe out whoever is left on the loan. Taxes take precedent over all of that. But with the intercreditor rights, it gives the second position lender additional rights that the first has. So what the additional lender rights would be like notices and things like that to indicate that the primary borrower is falling behind. And then as I touched real quick on the limited partnership, usually how I structure those is they'll be, a part of the purchasing entity that as either be LLC or however it's structured, and they'll be on as like 20% on the as a grantor on as a non-guarantor on the entity. And then it's pretty much like a silent partnership where they'll be on board, but their main objective is just to bring the capital in the transaction. And then the UCC1, as I was saying, is just another form of securitization where it's essentially, let's say I'm purchasing a property under an LLC. Um, UCC1 filing is a lien on the LLC, and then the LLC owns the property. So it's just another form of creating more security for whoever is investing with us. Um, so pretty much, yeah, we can go over that. And then our next strategy would just be real quick on the 48-hour return strategy, turn cash into quick profits. We usually do this in the form of people are familiar with double closes, where let's say I'm selling it to an end buyer for a higher amount, and let's say that amount I would be required to double close for whatever reason. PAs like that, where we may have to structure it that way in Pennsylvania, where we have to double close. 48-hour returns is that basically after the first leg of the transaction, the second leg of the transaction is either backed by an assignment, seller financing note, or a double closing where I have another end buyer under contract ready to buy it afterwards. Pretty much we'll use the fund for 48, we'll use the funds for 48 to 24 hours, and then whoever invested it is going to get it back plus their interest on the deal. So it's a pretty quick. We could do that with the found method as well if we need short-term funds in order to close the transaction as a transactional lender. And as I said on assignment deals, securitization, I went over those already. And yeah, pretty much this is a fast cash conversion cycle strategy of people who are looking to get their cash back quick once they deploy it. And this is probably ideal for investors seeking fast and repeatable returns. So the case studies were just going to be really brief. This was one deal we did in Willingboro, New Jersey, South Jersey. We got it under contract at 215. We assigned it to a flipper at 245, and the after repair value was 400,000. So the exit strategy was wholesale, and this was more of an active strategy. Case study number two. This is actually currently active. I actually have this under contract currently. Contract price is 250. ARV once fixed up is 650. We're looking to do a fix and flipped, and this could work as a passive strategy, active strategy, or passive aggressive, where we have people lined up already. We have the title company lined up. We have the seller already on board. Got it at a great price. I got repairs and everything from a contractor, and pretty much we're just looking to flip the deal, but we need some funds in order to complete it. So this is a great opportunity. We already invested about $12,000 to remove an oil tank. We got a no further action letter from the DEP. Everything is buttoned up on this deal, and I'm really excited and looking forward to this one. And then the last case study is we got a 6-unit portfolio in Upper Milford, Pennsylvania. This is about like 5 minutes from Allentown. Um, our total purchase price, because we over leveraged on it, we kind of did like a found method on this one, where we over leveraged, but we're not getting back funds at closing. So this is also active right now. We're gonna need funds back, funds at closing to close this one. And total purchase price with all leverage included is 1.265, and total ARV would be 1.8 to 2 million, depending on what the exit strategy will be. Primarily, what we're looking to do is a buy and hold on to the funds for anywhere between 12 months to about 4 to 5 years. And then essentially, what we're planning to do is refinance out, pay off the seller financing note, and pay off any investors who injected any capital into the deal. This can work for all strategy as well. In the upper right corner is kind of how the properties are divided. It's three separate lots. First one is 4 units. The other two are just single families. And these are just more pictures of it. Really solid opportunity. A lot of demand in this area as well. So it's great, numbers in terms of what we're seeing on market. And pretty much, if you want to follow my company, you can go to that website right there. Also on Facebook and Instagram, you could find us at Finally Found PA. And that's pretty much my presentation. So thank you guys for taking the time to listen. Matt, I'm not sure if you have time for maybe a question or two, but that's all I have for you guys.
No additional questions um, from the group, but I had a question about, I think you kind of outlined this, but with the transactional lender um, in the found method, who's usually like what does the lender usually look like in those transactions?
So that lender, I kind of touched on it when I was saying the
Yeah.
48-hour returns. Those usually they get maybe like one or 2 points. Again, depends on the deal. They usually just get 1 or 2 points. I have a few people who do that for me already. However, if there's investors in here that sound like something that's up your alley, your question is how does it work or how do I find them? Or what was
Yeah,
the question?
that is exactly what I'm asking. It sounds like there's another
Yeah.
opportunity to participate in these deals um, in the transactional lender role, for
Yeah,
example.
no, I absolutely. So I mean, it depends on sometimes it may be a few 100,000, sometimes it just may be a couple of thousand, but they vary. So it just the key ingredients basically are the transaction has to have a second leg to it, meaning that there has to be something back in it, either an assignment, owner financing, or anything that's going to return the money back to them post closing.
Hmm.
So usually that's done through the title company. So it's just the main thing is I think with the transactional lender, it's pretty straightforward. It's just as long as the title company's on board and they understand what they're doing, that could pretty much be done with any transaction. Again, as long as there's something back in the deal afterwards that the funds are going to come back.
Got it. Stanley has a follow-up question from his original questions, which is how do you find your deals?
Yeah, so I source everything direct to seller. So right now, our primary source is cold call. So I have a team of two cold callers who they call leads for me, like raw data. And then once somebody kind of raises their hand and say, "Yeah, I want to, purchase. I want to sell my property." I then give them a call and say, "Hey, my partner Mary just gave you a call. I was looking to purchase your property. Can you tell me a little bit about it?" We go through the whole back and forth. I schedule an appointment to go see the property, and I lock it up and get a contract signed. I also do some text blasting. I also do door knocking. I'll just go out and get a list and just go in the area and just go knock on doors, like pre-foreclosure leads, mostly things of that nature, as well as missing one. Referrals. So referrals is another big one for us. Like I said, I go to 2 to 3 networking events a week. So I'm constantly going to new events. And I find, people there who maybe they know a friend or they have somebody who has a deal and they send it over to me and I can get it that way as well. So we're adding more marketing channels too. So me and my partner, we're actually going to a 2-day boot camp in Ohio next week, and we're going to learn about different marketing channels that we could implement into our business to, gain some more traction in terms of bringing in more deals.
Beautiful. That's about it for the questions, and we are at 12:50 right now, so I think we're good to wrap it up.
Awesome.
How I how can folks reach you if they want
Yeah.
to learn more about what you do or have any follow-up questions?
Yeah, so you could go over to this website. If you're looking to buy a property, you can go to this website and hit that tab that says buy a property and fill out exactly what you're looking for. If you're looking in the areas that I'm marketing in, simply just fill out a form for us and then tell us ideally what you're looking for. And I think there's a notes section somewhere in there too if you want to just put in passive strategy, passive aggressive, or active strategy, just so we know. And just say, what you're looking to do, how you're looking to partner. As I said, could I drop maybe my business card in the chat somewhere,
Yeah,
Matt?
absolutely.
Or
Yeah, I think
uh,
you should have the ability to chat to everyone.
yes. 1 second, it's loading. Perfect. Okay, here we go. Let me see if I can find it. Here we go. Perfect. All right. Did you guys get that one? So that's my online business card as well.
Not
Um,
quite. Do it again,
oh
but
no.
where it says two hosts and panelists, change that in the drop-down menu. Can you select everyone?
Hold on. So chat. Okay, got it. So just okay, host and panelist, right?
You want everyone.
Oh,
Is that
it
an
just
option
says
for you?
host. No, it just says Matt or host and panelist.
All right. Is that, I'm sorry. I have to be the one who does it because I'm in control.
Oh, okay.
So, yeah, I will, if everyone doesn't mind having me open up the business card, 1 second.
hmm
Okay. Let's find this here. Okay. Try this one more time. My computer's choosing right now to lag a bunch. All right, I just shared your business card with everyone. So if people who are listening right now should be able to see it. And if for some reason you can't download it, you can always just reach out to engage at campbellplan.com and we'll get you that contact information. Perfect. So thanks everyone for joining today. Always appreciate your time and really appreciate you participating with questions. And thank you, Louise, for joining. Is it Louis or Louise?
Yeah. No, Lewis is fine. Yeah,
All right,
Lewis.
Louis, thank you very much for this great presentation. Very, very interesting, very, very different. And yeah, everyone have a great rest of your week. Have a great weekend, and we'll see you on the next one.
Thank you.
Bye-bye.